Investing is a cornerstone of building wealth, but the strategies used to invest vary significantly depending on your goals, risk tolerance, and personal preferences. Two of the most discussed strategies in the financial world are active investing and passive index investing. While both aim to grow wealth, they differ drastically in execution, cost, philosophy, and outcomes. Active investing seeks to outperform the market through frequent trading and deep research, while passive investing aims to mirror the performance of a market index with minimal buying and selling. Understanding the differences between these two approaches is crucial for investors looking to make informed decisions about their portfolios. In this video, we will break down the top 10 major differences between active and passive index investing, so you can determine which method suits your financial goals and investment style. 1. Investment strategy. The most fundamental difference lies in the investment approach. Active investing involves selecting individual stocks, bonds, or other assets based on market trends, earnings reports, and economic forecasts with the goal of outperforming the market. Fund managers or individual investors constantly analyze and adjust portfolios to seize short-term opportunities. In contrast, passive index investing aims to replicate the performance of a specific index, such as the S&P 500 or Nasdaq 100, by holding all, or a representative sample, of the index's components, with little or no active management involved. The goal is not to beat the market but to match it. 2. Cost and fees. One of the most apparent differences is the cost associated with each method. Active investing generally involves higher fees due to frequent trading, research costs, and management fees paid to professional fund managers. Expense ratios for actively managed mutual funds can range from 0.5% to over 1% annually. On the other hand, passive index investing is known for low fees, often with expense ratios below 0.2%, because index funds require less human oversight and fewer transactions. These lower costs can significantly affect long-term investment returns, especially due to compounding. 3. Performance expectations. Performance outcomes tend to differ, especially over long periods. Active investors believe they can outperform the market by making informed and strategic decisions. However, historical data shows that most active managers underperform their benchmarks over time due to market unpredictability and high fees. Passive investors, by contrast, accept market returns as satisfactory and focus on long-term growth through consistency, not short-term gains. As a result, passive strategies often beat active strategies in real-world performance once fees and taxes are factored in. 4. Time commitment. Time and effort required for active investing are much higher. Active investors must constantly monitor the markets, read financial news, conduct research, and adjust portfolios based on market trends or breaking developments. It's time-intensive and often requires professional expertise. Passive investing, by contrast, is hands-off. Once an investor chooses an index fund or ETF, there is little need for ongoing research or trading. This makes passive investing ideal for people who prefer to set it and forget it. 5. Tax efficiency. Taxes can significantly erode investment returns, and here too, passive investing holds an edge. Due to frequent buying and selling, active investing often triggers short-term capital gains taxes, which are taxed at a higher rate than long-term gains. Passive investments tend to be more tax efficient because they involve fewer transactions, which reduces the likelihood of triggering taxable events. Index funds are designed to be held long-term, often generating mostly long-term capital gains, which are taxed at lower rates. 6. Transparency and predictability. Passive investing offers greater transparency and predictability. When you invest in an index fund, you know exactly what assets the fund holds because it follows a clearly defined index. This makes it easy for investors to understand where their money is going. In contrast, active funds can be less transparent, as fund managers might not disclose real-time holdings or changes in the strategy. This lack of clarity can make it harder for investors to track performance or know how their money is being used. 7. Risk management approach. Active and passive investing differ in how they manage risk. Active investors use strategies like sector rotation, stop-loss orders, or hedging to limit downside exposure and seek better returns in volatile markets. They believe market timing and security selection can reduce risk. Passive investing, on the other hand, accepts the inherent risks of the market and focuses on broad diversification to mitigate them. Since index funds often include hundreds of companies across various sectors, they naturally reduce the risk of any single investment performing poorly. 8. Flexibility and control. Active investing provides more flexibility and control for investors who want to capitalize on emerging opportunities or quickly exit underperforming positions. This can be an advantage in volatile markets where timing matters. Passive investing, however, is relatively inflexible. Once an index is selected, investors stick with it regardless of short-term fluctuations. This approach favors discipline and long-term consistency over short-term reactions, which some investors may find too rigid, while others see it as a benefit. 9. Market belief and philosophy. The two approaches are rooted in different beliefs about the market. Active investing is based on the belief that the market is inefficient, meaning skilled investors can identify mispriced securities and profit from them. Passive investing is built on the efficient market hypothesis, which asserts that all known information is already reflected in asset prices, making it nearly impossible to consistently outperform the market. These opposing philosophies significantly shape how investors approach their financial planning. 10. Suitability for different investors. Ultimately, the suitability of active versus passive investing depends on the individual's goals, knowledge, risk tolerance, and time. Active investing may suit experienced investors or professionals with the time and expertise to analyze markets. It also appeals to those seeking above-average returns and willing to take on more risk. Passive investing is ideal for beginner investors, long-term savers, or those seeking simplicity, lower costs, and broad diversification. Many investors even combine both strategies to create a hybrid approach tailored to their needs. Choosing between active and passive index investing is not a matter of right or wrong. It's about understanding the trade-offs and aligning your investment strategy with your goals. Active investing offers flexibility, control, and the potential for higher returns but demands more time, effort, and tolerance for risk and fees. Passive investing emphasizes simplicity, cost-effectiveness, and consistent returns over time, making it ideal for those who value long-term growth without daily market stress. By understanding these top 10 differences, you can make informed decisions and build an investment portfolio that reflects your financial vision, risk appetite, and time commitment. Whether you lean toward active management or prefer the low-maintenance path of index funds, clarity on these distinctions will help guide your journey toward financial success.